Okay, this is always a treat because I feel like, again, like Kirsten just mentioned, she probably doesn't need an introduction, but it's only right. And Ann-Marie Laurie is the chief economist for CREB and probably the smartest person at CREB, which, no, she nod your head yes and no. So we absolutely love this, and I truly believe, and I have to say that bringing you onto the team was one of the best things in that I think CREB has ever done. And I love so many things that CREB has done, so that puts you even higher. But I want to thank you for taking the time to share the knowledge and share the information. It elevates realtors. It really sets us out as a great team of professionals. And I just got to say one thing, I love how accessible you are. That people just ask you a question. Like I've had people call you or send you an email, and she just responds. I'm like, you got Economist things to do. Like, how do you have time? So, Ann-Marie, welcome to the show again.
Thank you.
So, a couple of you were asked the CREB forecast. Many of you online were not at the CREB forecast. So, the theme of today's topic is going to be the rental market. But in a couple minutes, what was the theme of the forecast? I heard, so we weren't here. We got back. I heard it was a little gloomy.
It's all a matter of perspective, I guess.
Right.
Perfect.
So I look at it more as we're not changing much this year over last year. So we were starting to see improvements. We're not as bad as what we were over a couple of years ago. We just came through a bad recession, and it needs to be put perspective on that. So we are still climbing out of that recession. We're still starting to recover, but the housing market this year is facing additional challenges. So while the economy is starting to not be as bad, we'll put it that way. That's the best way I can think to put it.
Yes.
We're looking at other things. So now we've got we have a lot of inventory in the market. That's influencing pricing moving forward. Other factors is we've had mortgage rule changes. That in combined with rising rates, that's weighing on the market, and that's going to slow that recovery period. It doesn't mean it's going to completely stop it. It's just going to slow it. And we're seeing a change, and it's an adjustment for people now. And this housing market's going to be really different. The job growth that we're having is not in our traditional sectors. So that influences where housing demand shifts to. So, and you have to work through really some of those indicators that are coming out. Some of the ones that get to me is, well, Alberta's leading the country in growth. Well, that doesn't really mean a lot when you've come from such a low level.
Right.
So you have to put it in perspective.
Yeah, going from like negative 5 to 10 is like, it looks like a big number, but it's
not. And I mean, even though we're expected to see that for the next 2 years, we're still not back to where we were in 2014. So it's just putting perspective that, yes, we're starting to get better, but we're not booming. And that's a big difference. And that's an adjustment for people because we've gone in Calgary. I mean, people are used to, okay, now things are going to start ramping up. It's not the case. We don't have a lot of migrants in. There's still a lot of things that are slowing our market or preventing faster growth. So.
Cool. Well, or maybe not cool. Maybe
not cool.
Yeah, it's like if someone tells you, "Oh, my so-and-so passed away." Oh, that's awesome. It's like, listen, Lindsay, listen. I gotta stick with it. Okay, so turn us to. Actually, let's give the number here. So, what was your forecast for price growth?
Basically flat.
Flat. Okay.
Yeah. So and not in all sectors. So I do expect that prices will continue to fall for the apartment condominium sector. There's just too much supply in the new home sector to keep prices, like it just can't. So I'm still expecting falls there.
Yep.
Detached, this one, it's slightly lower than last year, but you have to put some perspective on it. It's essentially flat.
Right.
But there will be some shifts in the detached market between certain segments of the market. So I expect there to be much more oversupply in some of the higher ends of the market, because there hasn't been job growth in that area. Plus, you've got new lending rule changes that will prevent some people from basically being able to upgrade into those areas. So I think that segment of the market might face some challenges. But at the lower end, there will be more demand in there.
Right.
So I think that this is an interesting year in the way that you really have to look at what those supply-demand balances are within each sector of the market. On the whole, we expect it to be fairly flat, but I think you're going to have different trends depending on what segment you're in.
That's a great point.
And attached is a little different. Attached has been the area that's been benefiting, because typically when people can't afford detached, the next thing that they turn to is attached. So we've seen some pickup in that segment of the market. Prices there are probably going to be just slightly above last year. Again, still pretty flat. There still is too much supply to really generate some strong price growth. But at least it's not, that area is benefiting a bit just because of some of that shift from detached into attached. Now, for many people, they've said, well, the apartment sector, shouldn't that benefit if people have to switch down on the line what they can afford?
Yeah.
The challenge with the apartment sector is it's not just resale supply. There's a lot of new product that you're competing with. And builders are getting fairly aggressive at ensuring people choose new versus resale.
Right.
Can I ask a question that'll show that I don't read the stats as in-depth as I should? Because I should probably know if this exists. So one of the things I think that you said was very interesting is you can't just talk about the absorption rate because it's so broad that it actually doesn't mean much. Well, obviously, we talk about but we do break it down between detached and condos. But if you were to look at the CREB stats, does it break down absorption rate on
Various sectors, yep.
Yeah, oh, absolutely.
Every sector. That might be something, if that's going to be a big
Yeah.
deal this year, that maybe that's something that we start talking about a little bit more.
And it's important to look at it. I mean, again, you look at apartment condos, very different story versus detached. And then my next step would be, well, why? Why is it different? And that's where we have to think all of our numbers just show resale activity. It's not including all the other housing supply options. So it's not including the rental. It doesn't include options in the new home market. And that can influence it as well. So sometimes you can get figures. I see it in detached, more so in some of the areas with new communities, that your months of supply doesn't actually look that bad on the resale side. But you have to consider you're, again, competing with all of that new home inventory product.
Yep.
So when you do break down those numbers, and we provide it for every community, every district, every product type that we have enough data for, just be aware of if you're competing a lot with the new home sector, because sometimes you'll get a month's of supply that looks really decent for a detached market, but you're like, prices are falling, what's going on? Yeah. And that's where I say look at what's going on in the new home side too.
Totally.
That's great advice.
So let's switch the topic to rental.
Yes.
Now, so give us a little bit really quickly. When you look at the rental market, how does that affect? Is it a leading indicator? Is it a lagging? Like what ends up happening here, or is it all just driven by labor? Tell us a little bit about the rental market overall and how it affects the big picture.
Theory.
In the big picture.
Okay. There's a couple things. First of all, there's the rental market. When people come into the city, they usually start off in rental. Right? So there's a couple things that rental influences. Now, when rental vacancy is high, you got to think what that does. For owners or for renters, they don't really have to move into ownership.
Right.
They have lots of choice. Their rental rates are probably not increasing. In fact, we've seen in Calgary over the past 2 years, rental rates have decreased. So they're paying less.
As a landlord, been there.
Yeah.
Taking a hit.
So they're paying less to be in rental, and they have a lot of choice. So it's not pushing them into ownership quickly. We think about how that influences the market. Well, they're not moving into ownership, and no pressure to do so. The next thing to consider with rental is that if you don't have the people coming in, so for me, it's more about it's almost an indication a bit of what migration's doing too. If those vacancy rates are high and you don't have a lot of people coming in, what's absorbing up the additional inventory in the market, right? Because there is always a natural level of activity. But if no one's coming in and your vacancies stay high, then what will drive people to ownership?
Yes.
And that's some of the challenges. And then there's also the investor aspect. So that's the ownership component. Well, what about investors who look at it? Well, when you have high vacancy rates and rental rates declining, it doesn't really encourage a lot of investor confidence either.
Right.
Another thing you have to consider is with all rental data, most of that vacancy only includes purpose-built. So it does not include everybody who rents their condo.
Right.
Everybody who rents their individual house. So there's this entire submarket.
Yes.
It's a secondary rental market that's not included. So when I'm looking at those numbers, I don't look at it and go, oh, it's 7% vacancy. That's really not that bad. I go, well, how does that vacancy compare to historical levels? And we're still really high. And what's been interesting when you start breaking out some of those numbers is that there's been some of that level is because there's just been new rental coming on. So we saw rental construction in 2014, something that hasn't happened for many years. But now, because we don't have people coming in, it's difficult to absorb it. So that's why vacancy rates are staying fairly high. And then there is some, so CMHC does do some measures of The number of condominium units coming on the market wouldn't include detached, only condominium units. And they're showing that a lot more of them are ending up on the rental market. So when that happens, I mean, again, you've got people who are having their condo and they're not considering, they either, if they're going to rent it, they might not be getting as much as they expect. So that assessment of a rental as an investment as well has changed. Oftentimes in our city, people have just gotten used to, you can hold a property, you can hold a condo, rent it for a little while, you'll gain on the appreciation.
That's right.
Well, there hasn't been appreciation in condo for some time. I mean,
right.
If we look at the prices, it's gone down by 14% from 2014. It's lower than it was in 2007. That's not even adjusting for inflation. So this has been a segment of the market that has struggled in terms of price growth. So that assessment for investors is going to have to shift.
It's just, you got to look at, we've always, in my course, and it's been fallen on blank ear or on deaf ears because deaf ears, because we tell people investing courses, because Calgary has 2007 through 2004 to 2004, we've seen the price growth, 2004 to 2007 anyways, and then and we tell people it's you need equity pay down and cash flow. That is the numbers you have to look at. You can't anticipate appreciation. No. And that's exactly what you're saying right now, is that we just can't factor in appreciation in the numbers. No, and if you're losing money every month on your rental. Oh yeah. Yeah, there goes your cash flow. That goes your cash flow piece. Yeah, so and I mean back in another life, I used to work on investment stuff. This is what I did. It was always a cash on cash investment. You always had to look at it in that way. And when you don't, then you run into issues because, again, that appreciation hasn't been there. Have you done those numbers recently from the standpoint of someone were to say, okay, we've encouraged people to put down 20%. What if you put down 35%? Now to try to make it where it does break even or positive a little bit. Have you looked at the cash on cash numbers lately on that? I haven't. Okay. I haven't done any of that. Probably something interesting just from a standpoint of what the return is. And then the other pet peeve of mine when people calculate rentals, they say, oh, look how much money you made. And it's well, what about your crystallization costs? If you ever want to sell that, you're going to pay your realtor fees, you're going to pay lawyer fees, and they don't factor that in either. And it's well, that's nice in paper, but to actually pull that money out is going to require some additional fees you have to factor in as well. Right. Disposition costs. So. Well, and I think that's where, when we look at the entire market now, it's shifting in that the assessments have to come back to more what is traditionally done for real estate. So again, when you're looking at this as an investment, you're not thinking over a short window, you're looking over a longer time frame. So even though we're talking about the purpose-built numbers, you mentioned 7%, is that where the numbers sit right now? That's a current vacancy, yes. Current vacancy rate. Just under, I think it's about 6.5. Still almost near record highs.
And what would you say is the percentage where people are starting to move into home ownership? Is there kind of a certain number where you're if it's 3%, then there's more people, or 2%, then there's more people, or no? When we tend to see the ownership rates is when we do hit a level of vacancy that is non-existent. So when you see 2 to 3% vacancy, that tends to be a fairly tight market and rents are increasing. That's when we start to see some of that shift. Now, it could happen sooner, it could happen later, but it depends. Right now, there's nothing that's causing that. So once as you get to that low level of vacancy, then all of a sudden it becomes tougher to find product. So, and the rents are higher. So that's when people are doing, rent ownership calculations. When you see, I remember a few years ago, there was so many realtors doing campaigns like that where it was, this could be your rental rate or this could be your mortgage rate. And people were getting a lot of first-time home buyers off of that because they would put the numbers literally in these beautiful graphics that were very attention-grabbing and influential. Yes. And that's not happening right now just because there is too much rental. And you would have to see it come down to kind of traditional levels before you start seeing more shifts to ownership. And with that, there's also a lot of people who are assessing the risk of it now and looking at it going, well, how long am I going to be in Calgary for? Right. What is my opportunities? So it's also that assessment that comes into play. There's been also a lot of talk over various generational differences and right. Yeah. And millennials rent and only. Yeah, and again, I've said we don't really know what people are doing in various age groups, so I'd always caution about looking at that. But I look at it and go, okay, so if you're looking at it as a longer term, you're committed to this city. Traditionally, detached has outpaced inflation, and really that's where housing should lie. It should be
at a
On the
rate.
appreciation side.
Yeah, it is. It's meant to be somewhat in line on a longer term basis, in line just above inflation. Detached has done that traditionally.
Right.
We've outpaced inflation, and I've done it over decade chunks. Last 10 years, even with price adjustments, in the detached market has outpaced inflation.
Even in the last 10 years?
Yes.
Wow.
Yeah, so it has. And I mean, the previous decade, I mean, it far outpaced inflation. So when
Yes.
you do those types of adjustments, you can see a different pattern. Now, the condo market's a little different. So that hasn't been the case in the condo market. And part of that is the supply. And it all ties in together when we look at the rental. If you don't have migrants coming in, it makes it difficult to absorb up that rental supply. There's also all that new home product that's on the market that's coming in. Well, you need to get all of that. You need to get those inventories down across the board before you can start to see more stability in prices and improvements.
I want to ask you one question on migration, because you're so focused on that when at the forecast all the time, and I know that's kind of a thing for you. So compared 3 years, 2 years ago this year,
Yeah.
what does that look like?
Well, okay, so it's not just migration, it's migration and population growth.
Yeah.
Okay, so it's the
Fair.
combination of the two. Prior to 2014, so prior to the recession, we had roughly about 20,000 migrants into the city every year. That was fairly high, but I mean and we had population
You'd say
growth
that 2014? That would
prior to. So I look almost at 5-year chunks.
Okay.
Okay,
Nice.
so we had this 5-year chunk of time where really we had 20,000 migrants, roughly, if not more, every year. 3% population growth per year. That was very strong growth. Then now we've gone through this switch, and I'm imagining the graph in my mind, but we basically went from 20,000. We had outflows in 2016, but it's about the pattern of growth moving forward. So we're expecting 1,000, 2,000 migrants
Wow.
every year. Like that is a big difference.
Substantial change.
So that's why I
goosebumps. That's so tiny.
yeah, and that's why I'm
that-
focusing on that, because that's really different than the 20,000. And if you don't have them come in, it doesn't. Now it is better that it's not minus. Like more people aren't leaving than coming in, so it's still positive, but it's not very strong. And the challenge is that means it's going to take a lot longer to absorb up all that additional supply, because you have to look at it relative to how many households are forming. So yes, there's people having children. Still, they might need other households. Some of those kids are moving out on their own. They're creating new households. But there's over 11,000 units coming onto the market. Who's absorbing them?
Yeah.
And that is the challenge, is it takes time for that product now to come down. So you might be left with this additional supply in the market for some time. And there's nothing that's causing a real spike in migration. So when I look at it, traditionally, the reason why we have a lot of inflows is because we're creating high-paid jobs.
Right.
Right? When you don't have the higher-paid energy sector jobs, it's very difficult to attract migrants here. So those things all come at play. So without those conditions in the economy, it's really hard to see those migration numbers come up. And that's the expectations. Now, I don't forecast the migration numbers.
Yes.
I do take that in, and that's the one I watch. And City of Calgary is, over the next several years, they're just not expecting a lot of migrants. We're not expecting to get double digits till at least 2020.
Right.
So that needs to be put in perspective when we talk about our pattern of growth. That is one of the main reasons why we're not expecting any fast recovery in this market, as we just don't have that inflow of people.
All right.
I got one more quick question. Are they still, and this is probably my faux pas for not being aware of this one, but are there still purpose-built rental buildings being built right now? Are you aware of any projects that are newer? Or?
I think there's things that are still being completed.
Right.
But I do think those numbers have slowed.
It'd be tough to justify a new start by a developer
gosh.
at this point in the market.
I'm always amazed at what they do.
That's true. Yeah,
at the
absolutely.
same time, we had over 7,000 multifamily unit starts last year.
Yeah.
So you have to, they have different reasons for doing what they're doing.
Yeah.
But I've also looked at those numbers and went, you've got 7,000 starts, you have oversupply, but they're not necessarily pulling back on those numbers.
For those of you really quickly, just purpose-built, obviously the building is built specifically to be a rental. It's not a condominium. The whole building is a rental.
Yeah.
So interesting.
Yeah.
Fascinating.
Yeah. Anne-Marie, and just final question in kind of 30 seconds here. When people find out you're the chief economist of CREB, I'm sure they ask you, how's the market?
Yes.
So let me ask you this, from the perspective of a seller, perspective of a buyer, Someone comes up to you, a layperson, what do you tell them?
You know, I might tell them an overall market condition, but I remind them that doesn't mean that's what your house is worth.
Right.
So this is where I think that a lot of people need to understand what market you're specifically dealing with. How much supply is in that market. Just because the market's balancing out and it's leveling off, it doesn't mean that's the case for your house. And this is often where people go, well, what do you mean? Well, overall aggregate trends, while you might know, okay, the economy's not changing much, things are finally stabilized, if you have too much supply in your segment of the market, it's not going to matter.
Right.
Right. So this is where I often think for any buyer and seller, I encourage them to work with you guys, first of all, because you guys know far more about that than I do. But understand your community. Look at what the supply is for that product type and how does that relate to the demand. Because it's not necessarily the same. I mean, even if we look at what happened in the city last year, the West End, based off our districts, they're the only center that has seen prices rise to similar to 2014. Well, again, those trends are very different than the rest of the city. Now, apartment condos, those are about the same across the board, so it didn't matter what you were dealing with.
Right.
But on the detached side, the West End saw prices come up back to where they were. Well, when you're looking at that, well, if you're living on the West End, that's a very different perspective than some of the other communities where prices were still falling last year. So you have to give that perspective of to specifically your area that you're dealing with. So when anytime people ask me, the first thing I'd say is, well, first of all, I don't know, because I don't know where you live, and I don't look at them, right?
I like that though, and have the confidence to just be like, this is so independent. It's so independent into segments right now.
Yeah.
And you guys got to be regurgitating this stuff to your clients, and just say, but you know what we do is we take an in-depth analysis, and you can give some overall trends, but I mean, your point is so well taken.
Well, that's actually a really nice conversation starter because you're not giving somebody a three sentence answer that ends with a period.
Yeah.
You're giving somebody a one sentence answer that ends with a question.
Yeah.
Which is very engaging, and it's a nice way to start a conversation and the opportunity to be like, well, let me know where you live. I'd love to be able to get back to you with that information because it's fascinating, right? Like, I mean, it opens it up, which is a good thing.
Absolutely.
Yeah.
Thank you for coming.
Ann-Marie,
We're so lucky when
so
you're here.
outstanding, awesome, all the time. So thank you so much. All right, we are going to be back talking about 6 ways to get more exposure for your listings.
Because now we know how important that is.
Exactly. Stick with us.
Timely.